And we'll start as we usually do it. Anybody have any? So what I think we would do is, if anybody has any general questions, we can ask those, and I can go into my little presentation. Hopefully it doesn't confuse. Hopefully it helps more than it hurts. And then we can look at specific questions, like working out specific problems or answering questions about specific problems. Does anybody have any general questions about anything? I guess that's what general means.
I'm just gonna type some questions that I have about the additional self-test. I'll just type the number on the chat box, and then like I don't have to interrupt it anymore.
Okay.
So like towards the end, like if you have time, if you can go over those questions.
Sure.
Thank you.
Okay, so
my main thing is how in depth are they going to go into this whole bonds and stock stuff on the exam, because there's so much stuff that you could get into really minute details, and
well,
it's hard to know what to study.
I think I commented last week, and then put it in the announcement discussion that went along with last week's video, that the bond stuff was actually quite general, not really in depth. Like honestly, I looked through the exam and honestly, like just understanding the concept that as interest rates go up, bond prices go down, and vice versa, so that there's an inverse relationship between market interest rates and bond prices, was like sufficient. In other words, I didn't see any really specific questions where it would force you to figure out say a bond's issue price based on anything like that. So it was that general when it came to bond issue things, which is cool, right? So like I said, what's interesting is when I studied for my brokerage license, it was the bond stuff that really kicked my tail, and it wasn't really until I started teaching it where I had to study it at that level that you need to teach something, that I started to get a firmer grasp on it, because it's confusing, and unless you work with it all the time, it doesn't come. The good thing is about bond interest is you're going to learn about it, take your test, move on, and like unless you decide to go into bond trading or something, you'll probably never deal with it again. Maybe the concepts involved will be things that you will think of at other times, depending on what you do for a job or how you use the info. But the specifics is a pretty narrow subset of the field. Okay, so let me share my screen with you. Try to quickly go over a couple things before we get into more specific questions. So these are just a couple slides I stole from the textbook publisher. The first is just this process of what we do when we're going to issue par value common stock for cash. So the issuance of stock means that the company is actually making its stock available for purchase by investors, or allowing others to actually invest in or buy a portion or a share of ownership in the company. So here we have two different examples. One where the company issues 1,000 shares for $1 per share, and it's $1 par value stock. And then another example where they do 1,000 shares, but they issue them for $5 per share. So just so you know, in a real life scenario, what drives the issue price is the market. You've heard of an IPO, an initial public offering. In essence, what the brokerage houses do is they go out there and they gauge interest, and what the market is willing to pay for a stock is what it gets issued at in its initial public offering, which is sometimes way higher than the share's par value. The par value just comes usually from the corporate charter. So the state that they're chartered in as a corporation requires them to list some sort of a par value And a lot of companies just do $1 because it's this sort of arbitrary value that's not necessarily based on anything else. So it's a little confusing. So the first example, if we issue 1,000 shares for $1 per share, then all we're going to do is we're going to debit cash. The company's cash is going up, and we're going to credit common stock, $1,000, and that's it. So anytime stock is issued at par, cash goes up by the same amount as the common stock account. In example B, though, now we're issuing the shares for $5 per share, which is like we're issuing them for their par value of $1 per share, plus an additional $4 per share in paid-in capital. So again, if we're issuing 1,000 shares at $5 a share, our cash will go up by $5,000. Our common stock account will go up by $1,000 because the common stock account is always listed at the par value. And then our paid-in capital in excess of par value will go up by $4,000. So anytime a stock is issued above its par value, the common stock account will increase by the amount of that par value, and then paid-in capital in excess of par value will increase by any amount over and above that par value. Let's see. I think I may have included that slide. This just shows on the balance sheet how the common stock will, how it will look after that. So we issued $1,000 at par value, and then another, 1,000 shares at par value, then another 1,000 shares for $5 a share. So the paid-in capital section will show $2,000 worth of common stock, and at the par value, and then an additional $4,000 in paid-in capital in excess. So that's the first takeaway, I guess. It's going to come up. You've seen this already in the homeworks. The second is the idea of treasury stock. So recognize that treasury stock is just shares of stock that have been issued and are outstanding, meaning people out there own it, that the company then buys back and holds. Sometimes a company will buy back stock and then cancel it. They do that when what they're trying to do is reduce the amount of stock that's out there on the market. Other times they buy it back and hold it as treasury stock, and they usually do that because they're going to use those shares of stock for some purpose, like selling it to employees for their stock ownership plans or something else like that, or maybe preparing to pay it out as a stock and pay out the stock for some other purpose. I mean, sometimes companies will acquire a piece of property, and rather than pay cash to the people they buy it from, they'll pay them in stock. I mean, all sorts of things. So treasury stock is just stock that has been already issued, so it's out and then is outstanding, meaning it's been purchased by outside investors that the company then buys back and holds. And so here's our example. They acquire 4,000 shares of their stock at $8 per share. So that's going to be $32,000 worth of treasury stock. So that'll be our debit to treasury stock, and our cash will be credited or will go down by the same amount. So treasury stock reduces the amount of shares that are out there outstanding because now we bought them back into the company.
So what is the balance on the account? Is it a debit?
So yes, the normal balance for the treasury stock account is a debit balance. So if you think about it, a treasury stock account is like a contra equity account. Since our stock account, common stock account is an equity account, treasury stock offsets that. It's I don't know that it's a true contra account in the sense that it is in the sense that it's a equity account with a normal balance on the debit side. So yeah. Short answer, debit balance for treasury stock is the normal. So now you'll see that the company still has 100,000 shares issued, but only 96,000 of them are outstanding because of the 4,000 that are sitting in the treasury stock. And so always on our balance sheet, we'll show our paid-in capital and then our total of, and then our retained earnings, and then our total of the paid in capital and retained earnings, and then it'll be less treasury stock. And that's just the norm of how it's presented on the balance sheet. Jesse, your strobe light there is gonna give me a seizure or something.
Oh, too bright. Okay.
No, it was like flashing. Now it's not. Now it's not. Anyway. I don't think it was too bright, Jesse. It was like, I think it was the way the camera was picking it up. It was like flashing. That was.
Oh, yeah.
You're fine. You can have your light however you want. You're a grown man. Anyway, so the third issue here is cash dividends. So when a company pays dividends, there's this process where they declare a dividend on a certain date. That's the declaration date. And then it's declared usually for a certain date that all shareholders as of a certain date will get the dividend, and then there's a dividend payout date, and that's just how they normally do it. So this one, for example, right here is on December 1st, this company Media General declares a 50-cent per share cash dividend, and then its dividend is payable on January 20th, so that's the payout date, to shareholders of record on December 22nd. So December 22nd is called the date of record. Anybody who owns a share of that stock on December 22nd will get 50 cents per share. So on December 1st, when they declare it, what happens is they're going to debit the dividends account, cash dividends account, and credit the dividends payable account, meaning they now owe those dividends. Then on the record date, there's no entry. That's just the date by which someone has to own the stock. And then on the payment date, which is January 20th, they're going to debit the dividends payable account, so they'll no longer owe it, and credit cash, because they'll be paying out cash to all those shareholders. Remember, all a dividend is a share of the profits of the company that's being paid out to the owners or shareholders of the company. In addition to cash dividends, sometimes companies will pay a stock dividend. That happens usually when they want to pay a share of earnings or something out to their shareholders, but they don't have a lot of cash, or they're reserving cash for other purposes. So instead, what they do is they give them more shares of stock. So you can see what I have on the screen there, that it'll change the composition of stockholders' equity. In other words, we'll be moving money from retained earnings into the common stock and additional paid-in capital accounts. Is what happens.
So I have a question about that.
Mm-hmm.
So if you're, so it changes the composition. Can you like explain that a little bit better?
I would love to explain that a little bit better. So here's our example. I'm not sure, someone has a child in the background that's making it hard for me to think. If you could just mute your mic unless you're going to talk, that'll help. It's not an attack on children. I love them. I've gotten, since my kids have all grown up, I've turned into like an old fuddy-duddy, and I have a hard time thinking with little kids around. And then my granddaughter comes, I just can't think for like a whole week. Totally worth it though. Anyway, all right, so here's our example. Medlin Corp declares a 10% stock dividend on its $10 par common stock with 50,000 shares outstanding. The market price is $15 per share. So before the dividend, this column here, they have 500,000 in common stock outstanding, plus 3,000 in retained earnings. So they have a total of 800,000 in their stockholders' equity and 50,000 shares. So when they create this stock, or this stock dividend, what it means is they're going to pay some of their retained earnings to buy more stock and then distribute that stock to the shareholders. So what they're going to do is, we had 50,000, if we do a 10% dividend, that means we're going to buy, I mean, sorry, we had 500,000. A 10% dividend means we're going to purchase another $50,000 worth, or another 5,000 shares at the par. Okay. So it's actually, they're going to actually purchase, I take that back. So to figure it out, you take your 10%, the amount of the stock dividend, times the number of shares. So now we know they're purchasing 5,000 shares, and the price of it is $15. Okay. So if we buy 5,000 shares, then our common stock account is going to go up by $10 per share, because that's the par of this stock. So 5,000 shares times $10 is 50,000. And then our paid-in capital in excess of par is going to go up by 25,000. That's the remaining $5,000 in paid-in capital in excess of par times the 5,000 shares. So our total paid-in capital is going to increase by $75,000, and we're going to pay for that out of our retained earnings. So whenever we do a stock dividend, the cost of purchasing the stock is going to come from retained earnings. So now, after the dividend, we have $575,000 in total paid-in capital. That's $75,000 more than we had before. And we have $225,000 in retained earnings, which is $75,000 less than we had before, meaning our total stockholders' equity is the same. So that's what it means by change the composition. When a company pays a stock dividend, they're simply purchasing stock at the market price and paying for that out of retained earnings, and then distributing those shares of stock to their shareholders rather than a cash dividend.
So the retained earnings will decrease and the shares, the number of shares will increase?
Correct.
Okay, but why does it say total paid in capital plus 75,000? I understand. So what that means is like the number of shares that have increased, the total paid in capital?
Yes, the number of shares increased by 10%, right? We had 50,000 shares. We purchased another 5,000 shares at $15 a share, $10 of which was common stock, and then $5 of which was additional paid-in capital, or paid-in capital in excess of the par value. So that 5,000 shares at $15 a share was $75,000 total. So that increase to our paid-in capital gets paid for out of our retained earnings. Paid-in capital goes up by 75,000. Retained earnings goes down by 75,000. So we're changing the composition in the sense that our paid-in capital and retained earnings accounts changed, but the total amount of our stockholders' equity did not change. Did that help, Patricia, or?
It did.
Okay. I know it's a little confusing if you don't work with it all the time.
It's just confusing. My problem with these questions are reading them, because if they change the words around, I can't it's really difficult for me to understand what I need to do.
Sure. And that's the thing with accounting, and like in real life is like always easier than accounting out of a book, because in real life, you know what you're doing. Like there's something happening and then you're just accounting for it. There's not somebody had to write it up and then you had to figure out like what Wiley Plus actually wants you to put. It's kind of like when you miss a problem because they wanted you to put something in parentheses and that wasn't clear from the instructions. That's frustrating. And so just recognize the concept at play is that when there's a stock dividend, the number of shares will increase, and those shares are purchased at the market price, which is usually some amount more than the par value. So we'll have a change to the par value because we're buying 5,000 more shares at the par value, plus a change by some amount over and above that, which will be the paid-in capital in excess of par. And whatever that total cost of purchasing those 5,000 additional shares is, will come out of retained earnings. That's the premise that is in play every time we do a stock dividend. So the other issue is stock splits. A stock split will reduce the market value of the share and increase the number of shares outstanding. So this happens usually when a company, for whatever reason, decides they want the market price of their shares to be lower. What they'll do is split them. So if there's a million shares outstanding and they do a 2-for-1 split, what will happen is the market value of the share will and the par value of the share will drop in half, but the number of shares will double. So that, again, the amount of money out there doesn't change, but it results in a lower market price and par price of their stock. What that does is there are just some companies that believe that if the market price of their stock gets too high, it really inhibits people from wanting to invest in the company. So some like to keep the market price low through stock splits. So here's an example. So instead of issuing a 10% stock dividend, Medline splits its 50,000 shares of common stock on a 2-for-1 basis. So we can see before we have 50,000 shares, total stockholders equity of 800,000. And that our par value per share is $10. If we split 2-for-1, it means now we'll go from 50,000 shares up by 50,000 more to have 100,000 total shares. But the par value per share will go from $10 down to $5. And you can see that nothing else changes. In other words, the amount of money that was paid in for that capital doesn't change. The amount of retained earnings doesn't change. It's just that there are now twice as many shares that are worth half as much. So every shareholder will have the exact same value to them. And then as the stock grows from there, it'll grow. I once met a lady who told me she'd purchased Coca-Cola company stock in 1949. Her husband had purchased it, and her husband had passed away. And I asked her if she still had it. This was in 2000, the year 2000. And she said, yeah, it was sitting in a shoebox in her back room. And I found out her transfer agent had lost track of her and had not been able to send her all of her stock splits over the years. And after we got a hold of the transfer agent, they sent her a new certificate for over 7,000 shares of Coca-Cola. And well, it was worth a lot more than what they paid for it in 1949. Anyway, it was an interesting experience. So that's all I have as far as some of the concepts from the chapter. I think it'd be helpful at this point. I know Cody had some specific questions, and I know Jesse did, and Patricia said she was going to share hers to the discussion or to the chat. So I think it would be good for us to maybe take a look at some of those now. So you guys want to throw out there what some of your questions are, and I'll try to address them. Jesse, there was like 11.2a.
Yeah, that's right. The couple of the problems that were giving me, well, I'm not quite sure what to do on December 31st
Okay.
on Part A.
Okay. And then there was another one too, right? Sorry, I didn't get to them
Yeah,
until later this afternoon.
Yeah, 11-6.
Is that in the first homework or the second?
That's also second
Okay.
homework.
Okay. And then Cody, what was the one that you were asking about?
Let me try to find it real quick. I'm not sure
Okay.
the exact number problem.
Okay.
That's what I'm trying to look up.
And then Patricia, I saw yours is in the chat. And then Janice, did you have any specific problems, or you're still muted, Janice?
I think
Sorry.
she posted on the chat.
Oh, did she?
In the
Okay.
chat.
Okay, thank you.
So I found it. It's 11-2D.
Okay, so both 11-2. Yeah, D is a little bit nasty. I will.
I was able to get payout ratio and earnings per share, just trying to figure out return on common stockholders.
Okay. All right, so let's take a look at these.
Got part A wrong on the 2-11-28. So that's,
Let's see. Okay, 11.2a and 11.5a. Okay, good. So let me pull that up. So homework 2. So let's take a look at brief exercise 11-6 real quick. I think this is the one you were asking about, Cody.
That was me.
Oh, sorry, Jesse.
Yeah.
So
this is kind of what you talked about earlier. I just wasn't quite sure.
Do you think you could also help with a problem from next week's?
let's stick with this week first, and we'll see.
yes,
Maybe
please.
maybe after everybody else goes, then I could stay on with you or something.
Okay.
I don't want to have. Some people are like, my brain can only handle one chapter at a time.
Okay.
Okay, so let's see. Stockholders Equity section, Sarasota Court balance sheet consists of common stock, $8 par, and retained earnings, 430,000. A 15% stock dividend, or 20,700 shares, is declared when the market price per share is $15. All right, so we'll start with what we know, which is our common stock is given to us here at the beginning, 1,104,000. No paid-in capital in excess. Retained earnings also given to us, and then our total stockholders equity. So that one is pretty easy, that column. So this issue of what we do after the dividend. So to figure out the amount of common stock, we just take the number of shares, 20,700, and multiply that by the par value. So 20,700. Whoops. I think I hit the number lock. 700 times the par value of $8 is 165,600. I add that to the common stock.
Hold on 1 sec.
Oh, that was weird.
Sorry, my son was crying.
It's okay. I'm sorry. I didn't mean to make you feel uncomfortable about him when earlier. I apologize if I did. 20,700 shares times $8 per share. So we're adding 165,600 to the common stock. So I add that to the 1,104,000, and that'll give me this new amount here. And then our additional paid-in capital. So if it was $8 par, and when we purchased it, it was at $15. The additional paid-in capital is going to be $7 per share times the number of shares, which is 20,700. So that'll be our additional paid-in capital.
Okay.
We'll add those together to get our total paid-in capital, and then our retained earnings is going to have to go up by that whole amount we just did. So again, I would say 20,700 shares times $15 a share. So that's the total amount that we added between the common stock and the paid-in capital in excess of par. So that's going to come off of our retained earnings. So our retained earnings is 430,000. So our new value is 119,500. So again, retained earnings just has to go down by as much as paid-in capital goes up.
I see. Has to be equal. Okay.
Yeah. And then our total stockholders equity should be the same.
Okay. And then outstanding shares.
It just goes up by the number of shares that we added for the dividend. So we had 138,000 to begin with. In fact, that's probably the trickiest part, is it doesn't tell you that. So to figure that out, you have to take the value of the common stock account at par and divide it by the par value. So 1,104,000 divided by $8 par value per share tells us we have 138,000 shares before the dividend.
Okay.
And then we add the 20,700 and we get
Right.
158.7.
Okay.
Did that help?
Yeah.
Okay, good. So let's look at 11.2a, since that one's on almost everybody's list, on their naughty list. If you have such a thing as a naughty list. All right. So I think you were saying down here December 31st, right?
Right.
Okay. And so to record net income, so it tells us here that our net income was $283,200. So to record net income, all we're doing is so if we had a net income, that would mean we had a credit balance on our income summary account. If you think all the way back to closing entries.
Oh.
So
okay.
yeah, no, it's like, wait a minute, we had to use that stuff again? That's unfair. So we would debit that account, income summary, and then we would credit retained earnings. So that's how we would deal with net income.
Okay. And it's just that what the net income was for the year.
Yeah, and it just tells us.
They gave us. Okay.
Yeah, it gave it to us, which was nice of them. Thanks, Wiley Plus. You guys are so kind. Seems like the guys at Wiley Plus are kind of like government agents, just thinking of ways to torture people. That's what I think. Anyway, and then these other ones as well, or was that the only one you were stuck on?
Yeah, the other two.
Okay. So then, let's see. On December 31st, it was and we paid our dividends that were declared on December 1st. So back on December 1st, we had declared this dividend, and we had debited or credited dividend payable, so that's a liability.
So let me make sure I got that number right. So it's for my number, they declared 45 cents per cash dividend on common stock. Okay, so you take that number and
yeah, so the trick to that is you have to figure out how many shares of common stock are outstanding as of that date.
Okay.
So
you have,
as of the first December 31st?
Well,
so
December
you have
15th actually, but
okay, so our numbers look like they're similar.
So up here, sorry, go ahead.
So common stock, they have 300,000 shares authorized. So I take that and subtract 5,000 from the common shares.
So, well, no. So authorized doesn't necessarily mean they're outstanding. It just means they're allowed to issue that many. So to figure out how many you have at the beginning, you take the value of that common stock, which is $1 million right here.
Yeah.
And divide it by the par or stated value. So if I have $1 million worth of stock out there, and it's $4 stated value, that means I have 250,000 shares outstanding.
Oh, okay. Yeah.
So that's my beginning point, so to speak. And then I recognize that I had treasury stock of 5,000 shares. So I'm going to subtract out 5,000.
In the solution, it had you adding in the 5,000.
Well, they're smoking dope because that's not correct.
And then it had you subtracting the 5,000.
Well,
and the 1,000.
so I think you're getting ahead of it. So then on February 1st, we issue 5,000 more shares. So we're going to add 5,000 for that.
Oh.
And then
okay.
on March 20th, they purchase another 1,000 shares of treasury stock. So we're going to subtract that out. So as of December 15th, we'll actually have 249,000 shares. Did you follow that, Jesse, or do I need to go through that again? Okay.
No, I got.
Okay, cool. So then when you know you have 249,000 shares, then you do a 65%, or what was your number?
45, but yeah.
Yeah, so you just multiply that by the number of shares, and that would give you the amount of the dividend back here on December 1st. And then that's the same number that you would use when you pay the dividend here.
Okay.
Or, sorry. here. Which one was it? Where we paid the dividend? There it is.
Well, I don't know that I'm going to get this done then because I got those numbers wrong.
Okay. Well, what do you need? Do you need me to?
Well,
Go?
according to Wiley, hold on, I have to. It says for December 1st, for the cash dividends, it says 250. This is for mine. So 250,000 is the 1 million divided by 4.
Uh-huh.
Then it has adding 5,000, which is stock that was purchased.
Okay.
And then it says minus 5,000 plus 1,000.
Yeah, that's confusing. So, because it should be, so it should be 250,000. The way I would think of it is it's the 250,000 you had less the 5,000 shares of treasury stock plus 5,000 for shares issued in February minus 1,000 for the additional shares of treasury stock. It sounds like the way they're putting it is they want to have their additions all together. So 250,000 plus 5,000 minus 5,000 and
Treasury
1,000.
stock.
Right, minus the 6,000 shares total of treasury stock.
They're adding the 1,000 and the 5,000.
I think they're putting the, do they have it in parentheses, like minus 5,000
Yes.
plus 1? Yeah, so what they're doing is lumping the treasury stock together in the parentheses, the 5,000 shares that originally were there plus the 1,000 more that were purchased. But I think it's confusing because the plus sign makes people think you add it in. But
So what you're doing is you're adding the 250,000 plus the 5,000 bought minus
issued, yeah.
Yeah, issued minus the 1,000.
Minus the 5,000 in treasury stock and then the 1,000 in additional shares of treasury stock.
So you're minusing 6,000.
Correct.
Oh. Okay.
Really, it's always just shares issued less treasury stock. That's going to be the number of shares that are outstanding.
Okay.
So we had 250,000 shares issued and we issued 5,000 more, so 255,000 issued. And then we had 5,000 in treasury stock and then an additional 1,000 in treasury stock. So 255,000 shares issued minus 6,000 shares of treasury stock means 249,000 total shares outstanding.
Okay.
Does that help?
That makes more sense than what they put in this solution.
Yeah, I don't. The use of parentheses probably means it's technically correct, but not technically easy to understand. Okay, Jesse,
Okay,
did I?
So when you're
Oh, sorry.
okay.
No, you're okay. Go ahead.
No, I'm just my next question's on B. So
Okay, and we're gonna get to Jesse. Did I answer, or did I skip one of these?
Yeah, could we do the cash dividend one?
Yeah.
the
Okay,
middle?
thank you. Yeah, I thought I skipped something. So I didn't mean to skip down like that. So in essence, what we're doing here is this other. It's a closing entry, and we're closing out cash dividends. So if we look up here, our cash dividends will have at the end of the year a debit balance of 18,000 plus another entry here of 161,850. So it was 18,000 plus 161,850.
Oh, okay.
So that account will have a total balance of 179,850 on mine. It'll be different on yours. So then to close it out, we have to credit that account and debit retained earnings.
Yeah. Okay.
Did that help?
Yeah, now I'm just going through my other numbers. Not sure if I got those ones right either. So
Only one
for
way to
October
find out.
1st, Yeah, on October 1st, we had 6% declare dividend on preferred stock.
Mm-hmm.
So that's 6%. So it's 6% of the 300, right?
Yeah, so yes, so $18,000.
Okay, that's the zero there. And then it'd be the same in November 1st because you paid it, right? Okay.
Yeah, that's just the getting rid of the payable and then reducing the cash.
Okay. So you take the 18,000 plus the incomes, the cash dividends from the December 1st.
Right. Yeah. So there's your preferred stock cash dividends, and then your common stock cash dividends. And I'm sorry, right here, the two of them together are your total balance, debit balance in your cash dividend account. So then to close it, you just credit that account and debit retained earnings.
Wrong here.
Are we good? Should I move to B?
Go ahead.
Okay, so B is just the T accounts for all of these. Janice, did you say you had a question on part B?
Well, I just wasn't sure, like if you scroll up, you have some amounts, and then in the journal you have amounts there. So are we adding amounts from the very top into
Yep.
like these? Yeah.
Yeah, so your preferred stock account has a balance of 300,000. So that first T account will start with a balance on 1/1 of 300,000. And then that one never changes. Common stock
Right.
had a balance at the beginning of $1 million. And then on February 1st, where they issued 5,000 more shares. So we're going to go 5,000 times the stated value of $4 will be $20,000 added to the common stock. And then the paid in capital in excess of par, right? If it was $4 stated value, and what did we sell it for? We issued it for 30,000. So if 20,000 of that was the par value or the stated value, then the $10,000 additional will go as the paid in capital in excess of par value. Oh, it says. Sorry, I hate all the scrolling. And I know I'm not alone in hating the scrolling. Oh, there it is on the common stock. So the common stock had a beginning balance of 480,000, and then that issuance on February 1st with an additional 10,000 in paid in capital. So now it has a balance of 490,000.
So we're taking the amounts at the top and seeing if there's anything to add.
Any changes to it?
The
Yeah.
journal.
Correct.
The journals ones is where we add stuff.
Yep. So it gives us our beginning balances, and then all of our journal entries will change the ledgers here.
You said you were done. You want more?
Is that good, or should I move on to C, or everybody has C?
I guess I'm just not sure whether to put it on a credit or debit side.
Well, wherever you entered it, you mean the beginning balance, or?
Yeah, watch it.
So you take the beginning balance and you add stuff in on the debit, then you put it below on the debit.
Well, so your beginning balance, so remember that all of these accounts are equity accounts, and equity accounts have a normal balance of credit. So these will all be on the credit side, except for Treasury Stock. Treasury Stock has a normal balance on the debit side. And then everything else you'll add either as a debit or a credit as you journalized it to the T accounts. So if I credited 20,000 to common stock here, then down here on February 1st, I would credit that would show that credit of $20,000 to common stock.
Hey, hey,
Okay, I see. All right.
we do not touch the TV. Okay?
Okay.
No.
All right. Whoever's talking, they need to mute.
We don't touch the TV.
Part C, we have this is just our balance sheet. So again, we're going to take those balances. There's our paid in capital, starts with our capital stock, our preferred stock of 300,000. I would get these amounts just from my T accounts. I would come up here to preferred stock. I have a balance of 300,000.
A question about the common stock on the balance, the income, no, balance sheet, you know, on the bottom.
Right here? Yeah.
Yes. So when you put the cash dividend declare on common stock, do you have to subtract the treasury stock? Or
When
the
you
cash
the bottom.
dividend would be the amount that is right in front of the common stock?
So this number right here that I have is 1,020,000.
Yeah, is that the cash dividend declare?
No, that's just that is the stated value of the common stock. So that's just the balance on your T account right here. Had 1 million, issued another 5,000 shares at $4. So that has nothing to do with the dividends. That's just the amount of the common stock, or the common stock.
Okay, so where are the dividends?
I'll show you. So dividends aren't going to show up on your balance sheet. So the dividends are showing up here.
Mm-hmm.
Okay, and then you close them and they go to retained earnings. So in the end, what the dividends did right here is they just reduced your retained earnings. Up here is where you calculated how much those dividends were when you figured out, oh, okay, there's this many shares, 249,000 shares times, I think it was 65 cents on mine and 45 cents on Jesse's. So,
okay, so the dividends has nothing to do with the dividends won't be like, I don't have to calculate dividends and treasury, like.
So dividends do not have anything to do with the dollar amount of the common stock account. Instead, they have to do with the number of outstanding shares, which is the number of shares of common stock minus any treasury stock. So it's not the dollar amount that matters, it's the number of shares that matter when we're calculating dividends. Does that?
Yeah, it helps.
Okay. Anyway, so again, on the balance sheet, we're just bringing down these balances from the accounts, from the T accounts up in Part B. And that's it. And then D, this is where we have to do these ratios. I added a video to the discussion yesterday that showed how to calculate the payout ratio and the earnings per share, because someone had asked about that, but they had return on common stockholders equity already. But so was it you, Cody, that said that was the one you couldn't get?
Yeah, I was able to get payout ratio and earnings per share. You return on.
I should have just done all three of them on that video, huh? Sorry, I was answering a specific question. That's how it goes. What's easy for one person is the hard one for the next guy. So to find our return on common stockholders equity, return is always like I guess another word for net income or operating income. So somewhere in this, it probably told us, oh, it did up here, huh? It told us the net income for the year was, on mine, 283,200. So it's that net income divided by the average common stockholders equity, which is the total stockholders equity less any preferred stock. So let's see if that turns out right when we try it, or if I'm thinking crazy, because sometimes I do that.
So in the book, it says net income minus preferred dividends over divided by average common stockholders.
Okay.
Is that right?
Sounds right.
Okay. I was just trying to figure out the common average.
So what we're going to do is we're going to take our, well, let's just look at what they tell us, what they did. So to get your beginning common stockholders equity, in essence, what you're doing is you're adding the, see, that's confusing. Let me just show it to you up here. I was thinking this would make it
You know why
easier.
they use like different amounts or numbers for each? Because yours is different than mine.
Yeah, they do that so that it's harder for people to cheat.
Okay.
So that even if somebody does it with their friend, they both have to work out their own numbers, which actually will help them both learn. That's their logic anyway. All right, so what we're gonna do to find our average common stockholders equity, okay, is we have to find our beginning common stockholders equity and our ending common stockholders equity. And to do that, we're gonna take the common stock, so to find the beginning, we're gonna take the common stock at the beginning of the period, so it's $1 million, plus any paid in capital in excess of stated value on the common stock, so that's the 480,000, plus the retained earnings, minus any treasury stock. So I've got.
Put it on a sheet.
I'm sorry?
I like when you put it on a spreadsheet because it helps it be more logical.
Okay.
For me.
So my beginning common stockholders equity, it's going to be my common stock, which in this one was 1 million, plus my paid in capital in excess of stated value for common stock. So I'm just going to say paid in
Excess, okay.
which for this one is 480,000, plus my retained earnings, which were 705,000, minus my treasury stock. So the total of all of that is my my common stockholders equity at the beginning of the period. At the end of the period, whoops, I have all the numbers I would need down here on my balance sheet, right? This is my end of the period balance sheet. So it's going to be my common stock, which is now 1,020,000. My paid in excess in capital on the common stock, which is 490,000. My retained earnings, which is 808,350, less my treasury stock,
It's off the screen a little bit.
What's off the screen?
The second last column you're doing right now, you can only see like the first number.
Is that better?
Yep. Now
Okay.
you can see all of it.
All right. So my average common stockholders equity then is going to be the beginning common stockholders equity plus the ending common stockholders' equity divided by 2. So that's the denominator for the return on common stockholders' equity. The numerator is going to be my my net income, which was $283,200 minus my preferred dividends. My preferred dividends for the year were $18,000. So, whoops. So my return on common stockholders' equity is going to be my net income minus preferred dividends divided by my average common stockholders' equity, or 12%.
Okay, that makes sense.
It makes sense, but it's pretty convoluted, right? Like you got to grab numbers from all over the place to make it work. So
Yeah. There's a lot of steps involved.
yeah. Welcome to accounting, huh? Lots of steps.
Yeah.
Okay.
Thank you for that.
Yeah, sorry it took so long. And then Janice, did you say you had one on 11.5? Let me go back and look at the comments.
I have to go back and look on my.
Oh, yeah, it just says 11-5A. So
I just have to click on it to see where I was. Actually, I got 5A. I think the main thing I have to do there is when I'm putting it in the balance sheet, I have to start with the balances that are listed at the top. Same as the other one.
well, so you have to, so it's asking us, let's see. Yeah, so we have to find the balances of the accounts, right? So on this one, it doesn't have us do the T accounts. We'll have to do those on our own on the side so that we can get the new balance of the account.
So basically, we're doing the same thing. We're taking the number that's listed at the top and then going through.
I don't know that. So let me read this. The corporation, the corporation assigned $4 stated value to the common stock. The ledger contained the following balances pertaining to stockholders' equity. So in this case, yeah, we're not changing it. It's just telling it what it wants us to do here is do the journal entries for the issuance of these things. So if it had 42,000 in preferred or 142,000 in preferred stock plus 20,200 of paid-in capital in excess of par, then we would do our journal entry here where the cash goes up by 162.2, the preferred stock goes up by 142, and so forth. So then on the balance sheet, we would just, these would be our balances of these accounts. So we would have preferred stock of 142, common stock.
So the numbers that we put in the journal are the numbers that we put in the balance sheet.
Yes.
We don't do anything with the ones at the top.
Well, the ones at the top are the ones we're using to put into the journal for this one.
Oh, okay, okay.
Yeah.
So if it was preferred stock, if I have preferred stock twice, then I would add, if it happened to be twice.
Yeah, in this case, there isn't anywhere that get repeated. But if you say if you had credited preferred stock in one item and then in another item, then you would add the two together.
Okay, so.
Or if you credited it in one and debited it in another, then you would subtract. Right? You're just finding the balance of the preferred stock account.
Okay. I just have to get the right order for the balance sheet. I think I have most of it.
And if I sit on it for a second like this, and then you can roll back on the video and pause it, and everything's in the right order. That's not cheating, by the way. Okay, if I show it to you here, you're not cheating when you use it.
Okay.
Like if only if everybody knew that we were showing all this stuff, they might tune in, huh? All right, are we ready to look at Patricia's? So Patricia, yours were on the self-test, I believe, right?
Yes, I really need help with that because I've tried to. I guess the online class has gotten all the tutors in high demand.
I
So
bet, yeah. Yeah,
I
because
can't
even the
schedule.
face-to-face classes are now in online, right? So
Yeah, they're all busy. I can't schedule, and I have a question about that. Those three questions, they're kind of similar. So if you go to
28, 29, and 6, I'm just writing them down, and then let me go to the self-test.
Yeah, what I need help with is like going through the logic of like how do you solve that problem, because I'm having difficulty reading. I know the concept, but when I find myself reading the question, I'm like, oh, I don't know what it's talking about.
Sure. Okay. So let me. So we're talking, let's see. Is it the self-test or the additional self-test? Additional?
The additional on chapter 11.
I'm sorry?
Additional
Okay.
on chapter 11.
Okay.
Yeah.
All right. So we're going to look at number 11 first.
And let me check. Let me just make sure that we have the same. Yes, we do.
Okay. So DeHessa Inc., 8,000 shares, 5%, $15 par, cumulative preferred stock, and 50,000 shares, $3 par common stock outstanding. No dividends were declared last year. However, the board of directors just declared $34,000 dividend this year. What amount of the total dividend will be paid to the common stockholders? All right, so the trick to this one is knowing this term cumulative first. Cumulative preferred stock means that if the preferred stock doesn't get paid a dividend one year, then the next year that the company pays dividends, cumulative preferred stock will get paid the dividends. They're called dividends in arrears, dividends from previous periods plus the dividends of the current period, all before the common stockholders will receive anything. So that's the concept I think they're giving us here. I'm just going to bring up my Excel spreadsheet. Oh, dang it. Sorry. All right. So this is 8,000 shares, 5%, $15 par stock. So the preferred dividends for 1 year.
So let me just ask you a quick question. Why do I always see a percentage whenever I see a question that's related to preferred stock?
Sure, because the way dividends, so what makes preferred stock preferred is that it has a fixed dividend amount, okay? And that fixed dividend amount is always represented as a percentage of the par value of the stock. So the dividend on these stocks is 5% of the $15 par. So our dividend will be $15 par times 5% times the number of shares. So in essence, this preferred stock will pay $6,000 in dividends each year.
You have next to arrears though, so that's
So this is
arrears,
yes. So this is the preferred dividends from last year that didn't get paid out. Those are called dividends in arrears. That means those are dividends that are owed to the preferred shareholders but have not yet been paid. Then this year's dividends will be another $15 par value times 5% times 8,000 shares. So the total preferred dividends that'll have to be paid is 12,000, which is 6,000 for this year's plus the 6,000 of last year's that weren't paid. So the total dividend was 34,000. So the dividend that's going to go to the common shareholders will equal the 34,000 total dividend minus the 12,000 that's going to go to the preferred shareholders, 22,000.
Yeah, that's the answer. So is that like a formula? You always solve the problem by multiplying those numbers, the par value times the percentage?
Yes. So to find out the amount of dividend per share of preferred stock, you always just take the par value of the preferred stock times that percentage, which is the dividend rate. And then you multiply it. So that would be the dividend per share, and then multiply that by the number of shares to get the total dividend for the preferred stock.
Okay.
Do you want me to, did I not?
I will have to watch it again and write it down.
I'm sorry.
It's just a lot of par value, and yeah, it just gets in my head, and it gets like it's.
No, I understand.
It's all twisted.
I understand. Maybe if I work out the others, you said they're similar. Maybe it will help lock it in there.
Yeah, they're similar.
Okay. At least for me, like if I hear the same thing a couple different angles, it really helps my brain grab onto it, you know?
Yeah, for me too.
All right. Weeds Inc. Has a balance of $10 million in retained earnings. That'd be nice. And declares a 5% stock dividend on its 1 million shares of $5 par value common stock. The current market value of the stock is $25 per share. What is the entry to record the transaction? Is that the one?
Yes.
Okay. So first thing we have to do is figure out how many shares we're issuing during this stock dividend, which is going to be it's a 5% dividend, so it's going to be 5% of the total number of shares that are currently outstanding, which we could do in our brain probably, but whoops, I don't know why that's expressed as a percentage. We just want it as a number. So this means, so if they're issuing a 5% stock dividend on a million shares, that means they're issuing 50,000 more shares, because you just take 5% of the million. Once we know how many shares we're issuing, we can figure out the amount. So it's $5 par. So our increase to our common stock account is going to be the number of shares we're issuing times the par value of the common stock, which is $5 per share. And then the increase to our paid in capital on common stock is going to be any amount over and above that par value. So in this case, if we're issuing it at $25 per share, it's going to be $20 per share of additional paid in capital times the number of shares we're issuing.
Times the number of shares based on the 5%?
Uh-huh.
Okay.
So remember, whenever we do a stock dividend, all we're doing is we're issuing more shares of stock. And then the number of shares we're issuing is the amount of the stock dividend, the percentage, times the number of shares that were already outstanding. So that's how we figured out that we're issuing 50,000 more shares of stock. And we're issuing them at $25 per share, which is like saying we're issuing them at $5 per share of par value plus $20 per share of additional paid-in capital.
So which one of these is the answer for this
All right.
then?
So now that we know that, the total amount of this dividend is $1,250,000. So our stock dividend is going to be debited $1,250,000, and then our common stock, since it's increasing, will be credited $250,000, and our increase to our paid-in capital on the common stock, in excess of par on the common stock, is going to be $1 million. So it's going to be, it should be this one right here, B.
Yeah, it is.
Patricia, did that help explain it, or is it still not making sense?
It did help. It did help.
Okay. So let's look at 29. It's Weeds Inc. again. Luckily, it's legal now, so they can sell as much as they want as long as it's medicinal, right? They have a balance of $10 million in retained earnings. They declare a 4% stock dividend on their 1 million shares of $3 par value common stock. The current market value of stock is 20 per share. So this is almost the exact same problem, except with different numbers, right? So the first thing we have to figure out is how many shares are issued. And the number of shares issued is going to be...
Actually, this one is for, the other one was the declaration date. This is the issue date.
Okay.
So would that be different?
Yeah, because it won't be the, here we did distributable, whereas when we actually do it, it'll be the actual dividend. So it'll I think, let's see. Weeds has a balance. Current market value of the stock is $20 per share. What is the entry to record the transaction when the dividend shares are issued? It's going to be the same process, okay? So let's figure out how many shares we're actually issuing first, which is going to be the number of shares, so 1 million, times the amount of the dividend, which is 4%. So we're issuing 40,000 new shares of stock, okay? And then this is stock that has $3 par value. So our increase, the common stock account, is going to be the number of shares issued times the par value. And then the increase to the paid-in capital on common stock is going to be any amount over and above that $3. So if it had $3 par value and we issued it for 20, that would be $17 per share in additional paid-in capital. So we're going to take the number of shares times $17. And then the total of that, whoops, we don't want to include the shares issued. The total of that is 80,000. So we're going to debit stock dividends, $80,000. So it's got to be one of these two. And then we're going to see that. So here's where they're tricky. This is where it matters that it's the when it's issued. So this would be the entry when we declare the dividend, okay? And then when we actually issue it, then we're going to have we're just getting rid of this distributable by debiting the common stock, or by debiting common stock dividends distributable and crediting the common stock. So I think it should be D. What's it saying?
It is D.
Okay.
So
So that's tricky, because what they're doing is they're giving you, in essence, the same problem, but here they're asking you to give the entry at the time is declared, which creates this dividend distributable. But here it's asking you at the time the dividend is actually issued, which is where you're just, in essence, getting rid of the distributable and paying out the actual common stock. So
Do not remember this distributable distributable thing in the book?
But just whenever you declare a dividend, so if it's a cash dividend, it's going to go as dividend payable. If it's a stock dividend, it's going to be dividend distributable, meaning you owe those shares of stock, at the date when it actually gets distributed.
So is an account for dividends related to being stock dividends? Is that what it is?
Correct. Yes.
Okay.
So what would happen here is once we figure out this math, at the date that at the date when we declare the dividend, we're going to do this entry that looks like this one B. So our stock dividend gets debited 800,000. Our dividends distributable gets credited 120,000. So that's like a liability, meaning we owe that dividend. And then the paid in capital in excess of par gets recorded right then at the time that we declare it. Then when we actually issue it, we're just going to debit the dividend distributable account and credit the common stock. So yeah, that's a fine distinction that's going to really trip people up if they have it on the exam.
That's why I was asking how detailed this is going to be.
And that's a really fine distinction. I always feel like it's not fair when they make such fine distinctions, but I guess life's not fair.
I'm sure it will be in the exam because they do stress a lot about that in the book, like telling that there are 3 dates, there is 1 date, there's no entry that you have to do because it's just like, oh, this is where, like those, I think you showed it in one of your slides.
Yeah, you're right. No, they do stress that heavily. And so they want you to
record date is where you don't.
That there's no entry for the record date. So you have to do 1 entry at the date when it's declared and then a second entry at the date when it's paid.
Yeah. And
that's what these two problems, I guess, back to back like that are kind of highlighting or illustrating. Number 6, which of the following will increase the paid in capital section of the balance sheet? So remember, the paid in capital section is our common stock accounts and our additional paid in capital accounts, but not our retained earnings. So the stock split is going to make no difference, right, to our paid in capital. We're not issuing any more stock. A stock dividend is going to cause the amount of stock to go up and the amount of retained earnings to go down. So that's actually going to be our answer. A cash dividend will just cause our retained earnings to go down, but not our stock. And a treasury stock acquisition, remember, treasury stock on the balance sheet gets listed down under everything else. So the only one that impacts the paid in capital section is the stock dividend.
Okay, because the cash, say it again, the cash dividend is where?
Yeah, so the cash dividend, if we do a cash dividend, then in essence it impacts our dividend account and our cash account. And then the dividends get closed to retained earnings. Remember when we do our closing entry? So that never affects the common stock or preferred stock accounts on a cash dividend. But with a stock dividend, we increase our common stock account and then decrease our retained earnings to pay for it. So it's the stock dividend that's going to actually impact that.
Okay. Thank you.
All right, I hope it was helpful. I know that it's the kind of thing that we could talk about for hours, and it's still sometimes just having to work through it a couple times that really makes it settle in.
Yeah,
but,
ready to go?
Sorry, Professor.
Yeah.
I made an error on that one that you're helping me with. I know other people had other questions, so I didn't want to hold up everybody. Do you mind if we go through it one more time?
I think we are at the end of all the questions we had listed out. So if anybody wants to go, you're certainly welcome to. You don't have to stay. Which one, Jesse?
Oh, the 11-2A. Can I do a share screen?
Sure.
You want to see what I'm working with?
Yeah, that'd be great.
Uh,
I may have to unshare
oh, somebody
mine.
else is sharing. Yeah.
Yeah, that's me.
That's you.
So let me stop my share. All right. So now you should be able to share yours.
Yeah. Okay. So all right. So you said that the million. So it's with the common stock again.
Okay.
So you said you take the 1 million divided by 4, right?
Mm-hmm. So that should be 250,000.
Yep. Okay. Then cash dividends. So, but that's not it, right? We still have to subtract the 5,000 shares.
Uh-huh.
Okay. Is it the cost of the 5,000 for the 40?
Nope, it's just the number. We're just doing the number of shares here.
Right. Okay.
So at the beginning of the year, you had 245,000 shares outstanding.
Yeah. And then they bought 1,000 more, right? So minus another 1,000.
Well, so they issued 5,000 more on February 1st, and then purchased another 1,000, and so it's plus 5,000 minus 1,000
Oh, plus 5. Oh,
for that
okay.
February 1st one. So at the end of the year, they should have 249,000 shares outstanding.
Right. Okay. So then that's what I'm multiplying by 0.45, right?
Yeah, to get your dividends on whatever
See,
it
I did
was.
that and it didn't like my answer. Okay, so 1, 2. Oh, nope, that's not.
I got
Yeah.
112,050.
Yeah.
Is that what you had in there?
Yeah. So that's it then, right? And then that'd
It
be the same down here.
it didn't like that, you said, though?
Yeah, I'm just wondering if I was doing something else wrong.
And then on the one above it, it should be that 112,050 plus the 18,000 in preferred dividends.
Plus 18,000. Yeah, that's what I got and it marked it wrong.
So let's, before we use up your other check, let's look at this and make sure we're not doing something goofy. Can you scroll up
Yeah.
for me? So let's see. Definitely starting with 250,000. Then we had 5,000 in Treasury, so that's 245 to start. Issued 5, purchased another 1,000, so that's 249 at the end. We did 249,000 times 45 cents, which should be 112,050, which is what we got, right?
Yep.
112,050, and then plus 18,000 should be 130,050.
Yeah.
I'm always afraid I'm missing something.
Right. So let me make sure I got the accounts correct. It's what I have here. I don't think that's correct, right?
No, you need retained earnings on that one.
Okay.
And then the other one will be cash dividends.
Okay. All right. So all these numbers look okay?
Well, they do, but let's see what it says.
Now it worked. Okay.
Okay, that's good.
I'll go through it to the rest of this then. Thanks for your help.
All right, thanks.
Appreciate it.
All right, thanks. All right, so Cody, are you still hanging out?
Yeah.
You want it? So did you want to look at the thing from the next chapter?
Yes.
All right, so
Next
why
chapter,
don't we have a prayer and end this meeting, and then you and I can just hang out, and I'll try to help you with that next one.
Oh, okay, sounds good.
What I do wrong? Yeah, there we go. Stop share.
All right. So anybody want to volunteer to give us a closing prayer?
I'll do it.
Oh, thanks.
Dear Heavenly Father, we thank Thee for all of our many blessings. We're thankful for the meetings, the weekly meetings, and we ask Thee please help us to study well this week. And we say this in the name of Jesus Christ. Amen.
Amen. Thanks. Have a good night.
All right.
Hold on, let me stop recording this meeting.